Did you know that over 60% of Americans feel overwhelmed when deciding where to invest their money? You're not alone. Whether you're planning for retirement, looking for passive income, or just trying to make the most of your savings, understanding your investment options is crucial. Today, we're breaking down two of the most popular choices: mutual funds and ETFs. By the end of this video, you'll know exactly which one suits your financial goals best. What are mutual funds? A mutual fund is like a financial buffet. Instead of putting all your money into one company's stock, you're spreading it across multiple investments. This is done by pooling money from many investors and letting professional fund managers handle the investments for you. Think of it as a team sport. Instead of playing solo, investing in individual stocks, you join a team where experts make the best moves on your behalf. But not all mutual funds are the same. So, let's talk about the different types you need to know. Equity, stock, mutual funds. If you're looking for growth, stock mutual funds might be your best bet. These funds invest in company stocks and are divided into three main categories. Large cap funds. These invest in big, well-established companies like Apple, Microsoft, and Amazon. They offer stability, but may grow at a slower rate. Mid-cap funds. These target medium-sized companies that have strong growth potential, but also come with higher risk. Small cap funds. High risk, high reward. These funds invest in smaller companies that have the potential for rapid growth, but are also more volatile. Bond, fixed income, mutual funds. Want a more stable investment? Bond funds could be for you. They invest in government or corporate bonds and offer lower risk than stocks. Government bond funds. Backed by the U.S. government, these are among the safest investments. Corporate bond funds. These offer higher returns but come with a bit more risk, depending on the company's creditworthiness. Municipal bond funds. Ideal for tax-conscious investors, these provide tax-free income at the state or federal level. Index funds. Ever heard of the S&P 500? Index funds track a specific market index like the S&P 500, meaning you're investing in a wide range of stocks with minimal management fees. These are a favorite for long-term investors due to their low cost and solid returns. Money market funds. If safety is your top priority, money market funds invest in short-term, low-risk securities like U.S. Treasury bills. While returns are lower, they're a good place to park cash temporarily. Sector funds. These funds focus on specific industries like technology, healthcare, or energy. They're riskier since they depend on one sector's performance, but they can offer high rewards if chosen wisely. Target date funds designed for retirement planning. Target date funds automatically adjust the asset mix as you near retirement. If you plan to retire in 2050, for example, a 2050 target date fund will start aggressive and become more conservative over time. How do mutual funds make you money? Mutual funds generate returns in three ways. 1. Dividends. Some funds pay out earnings from stocks or bonds to investors. 2. Capital gains. If the fund sells assets for a profit, that profit is distributed to investors. 3. Net asset value, NAV, growth. If the overall value of the fund increases, your investment grows too. Pros and cons of mutual funds. Pros. Diversification reduces risk by spreading investments across multiple assets. Professional management. No need to pick stocks yourself. Liquidity. You can buy or sell mutual fund shares anytime. Affordability. Many funds let you start with as little as $500 or even less. Cons. Fees. Some funds charge high management fees, which can eat into returns. Market risks. Like all investments, mutual funds can lose value. Less control. Fund managers make the investment decisions for you. How to choose the right mutual fund. 1. Know your goals. Are you investing for retirement, a home, or short-term gains? 2. Understand your risk tolerance. Can you handle market ups and downs? 3. Check fees and expenses. Lower fees mean higher returns over time. 4. Look at performance history. While past performance isn't a guarantee, it helps to see how a fund has performed over time. 5. Consider your investment timeline. The longer your timeline, the more aggressive you can be. Mutual funds are one of the simplest and most effective ways to grow your wealth over time. Whether you're a beginner or looking to diversify your portfolio, there's a mutual fund that fits your financial goals. So, are you ready to start investing in mutual funds? The best time to start was yesterday. The next best time? Right now. An ETF, or exchange traded fund, is a basket of investments, stocks, bonds, or commodities, all bundled together into one tradable security. Think of it like a stock market smoothie. Instead of betting on one fruit, you get a blend of many, reducing risk while still capturing market growth. Unlike mutual funds, ETFs trade on the stock exchange just like individual stocks. This means you can buy and sell them throughout the day at market prices. The beauty? Lower costs, better tax efficiency, and the flexibility to invest in different industries or even entire economies. Now, not all ETFs are the same. Let's break them down. 1. Stock ETFs. These track a specific index like the S&P 500, giving you broad market exposure. 2. Bond ETFs, a great option for stability, investing in government or corporate bonds. Third sector ETFs. Want to bet on tech or healthcare? These ETFs focus on specific industries. 4. Commodity ETFs. Gold, oil, or agricultural goods. These ETFs let you invest in tangible assets. Some ETFs are passive, meaning they simply track an index. Others are actively managed, where experts pick and adjust investments for potentially higher returns, but with higher fees. Pros and cons of ETFs. Pros: diversification, spreads risk across many assets. Liquidity, easily bought and sold like stocks. Lower fees, typically cheaper than mutual funds. Tax efficient, less capital gains tax compared to mutual funds. Cons: trading costs. Some ETFs have transaction fees. Market risk: if the market crashes, ETFs are affected too. Over-diversification. Too many holdings can dilute high-performing assets. ETFs are great for beginners, busy professionals, and retirees looking for steady growth without active management. Whether you're saving for retirement or just starting out, ETFs offer a solid foundation. Getting started is easy. 1. Choose a brokerage. Fidelity, Vanguard, or Charles Schwab are great options. 2. Pick your ETF. Consider factors like expense ratio, holdings, and performance history. 3. Invest consistently. Dollar cost averaging can help smooth out market fluctuations. Investing doesn't have to be complicated. With ETFs, you can build wealth steadily, reduce risk, and take control of your financial future. So, are ETFs right for you? Only one way to find out. Start learning, start investing, and start growing your future today.